Hello friends, today is my 20th presentation for the team of Corporate Finance and Accounts, and subject is implementing 99 cost reduction opportunities identified in finance and account function area, part 1. Overall, this is my 51st presentation, including all presentations, YouTube presentations that I made so far. I plan to include in this the approach followed for identifying cost reduction or cost saving opportunities, list of 6 areas under the direct control of the finance and accounts function where the savings opportunities have been identified, how how are the PPTs structured, a brief narration of these 99 cost reduction saving opportunities, and the way forward. Approach followed. Staying focused on the priority areas and closely examining the following aspects in each of the 6 processes I talked about, while ensuring no compromising on the quality of the customer service. These include basic rates and fees negotiation or expense reduction, covenants or terms and conditions, focusing on the payment terms, focusing on the speed of process execution, and statutory compliances. The 99 cost reduction opportunities that have been identified in part 1 to enable profitability enhancement in areas directly under the control of F&A. List of 6 areas. One is long-term borrowing with 21 opportunities. In this table, you can see second is IPO for equity, 7 opportunities. Merger and acquisition, 29 opportunities. Making investments, 21 opportunities. JVs, 14 opportunities. And royalty payouts primarily related to the JV, 7. So total 99. In fact, in addition, there are 79 more cost reduction opportunities that have been identified in 14 more functional areas in F&A directly under the CFO and shall be included in my next presentation as part 2. How are the PPT structured? Each PPT of 6 processes briefly narrates the cost reduction opportunities totaling 99 in all slides. These are highlighted in red color text on each slide. To keep the focus on the cost reduction, the process of performing business activities in these 6 areas is not included in these slides, as these are included in my second book. The book is titled as Profitability and Ethics, Essential Ingredients for the Business Success, and the book has been listed in the Amazon. Cost saving opportunities, long term borrowing credit 21. The split up of the 21 opportunities is as follows. Under the theme of interest and fees or charges, 2 opportunities, convenience related 13 opportunities, other cost reduction areas related to the borrowings, 6 opportunities. Number 1, interest and fees or charges related to the long term borrowing. Number 1, opportunity is to negotiate the interest rates aggressively based on at least 3 to 5 competitive bids. Number 2 is negotiating the below charges very aggressively. One is the prepayment penalty charges, restructuring fees, documentation charges, processing fees, legal fees, administrative fees, loan rescheduling charges, checks or electronic clearing charges, default interest charges, late payment charges, sharing of the stamp duty or other statutory charges, charges towards detailed security documentation and collateral requirements. Now these are the charges which normally FIs or the banks they impose, but one has to read these in between the lines and then negotiate these. Number 2 is covenants related. There are 13 opportunities. There are primarily 4 types of covenants which are there, which I will take one by one. Number 1 is the financial covenants. There are 3 opportunities for cost savings through agreeing on a debt service coverage ratio which reflects borrower's ability to generate sufficient funds to meet debt obligations, and also negotiating penalty for violations. Number 2, the interest coverage ratio, which reflects the borrower's ability to meet interest payments with EBIT and negotiating the penalty for violation. Third, the leverage ratio, limiting the borrower's total debt to its equity or assets, and also negotiating penalty for violation. Obviously, the FI or the banks they are going to put it these ratios which are favorable to them. Covenants related 13 continuing operational covenants. There are 4 opportunities identified in this. One is the limitation on the capital expenditure, restriction on the M&A, without lenders' consent, dividend restriction to disperse dividends to shareholders, controls over the change in the ownership, and expected borrowers by insisting on the lender's prior consent. These are also very, very critical for business future, and therefore need to be negotiated very carefully. The third one is negative covenant. There are three opportunities to negotiate. One is the restriction on the additional debts and securing other loans, lenders' prior consent before sale or transfer of any assets, restriction on the making significant changes in the business operations. These also need to be negotiated very carefully. Reporting covenant. The fourth one, I have the three opportunities. Periodic financial statement to be submitted, such as balance sheet, income statements, and cash flow statements to the lender, compliance with the financial covenants, and notice of default in case of any default of agreement and terms, and so on and so forth. Now, obviously, FI and banks will put very stringent conditions. One needs to negotiate all these very carefully. Other cost reduction ideas related to the borrowings. Explore alternate lower interest rate borrowing options like debentures, bonds, or government schemes. Negotiating credit assessment charges to enhance the credit rating to qualify for lower interest rates. Negotiating hedging costs for any foreign currency related borrowings, ECB or overseas loans. Negotiating fixed consultancy fees plus, negotiating not only consulting fee but also success fee, which is contingent on long term loan approval and disbursal. Negotiating expenses for charge creations, and instituting strong internal controls to prevent potential unethical activities caused by collusion. Cost singularities IPO rated. Now there are seven opportunities identified. Number one is the underwriting fees with the investment bankers, legal and accounting fees with reputed IPO dealing firms, roadshow expenses. Suggestion is that use a mix of online and traditional methods, which are they are very expensive, particularly in case one is traveling overseas. Printed media expenses, use alternate digital marketing material option also. IPO approval timelines, initiate timely documentation and approvals. IPO listing fees, pursue a mix of the stock exchanges with lower listing fees. And number seven, initial offer size, considering a smaller initial offering and subsequently follow on offering to reduce the initial expenses. M&A continuing, realize savings as summarized below. Consultant fee for due diligence, there are 6. Bid purchase price related 2. Bid purchase terms related 12. Statutory approval related cost 5. Post merger integration cost 4. So there are broadly 6 areas under the M&A where cost opportunities do exist. One is consultant fees for due diligence. Now there are different kind of 6 type of different key liars, key consultants which are listed here, like lawyers, investment bankers, risk managers, tax professionals, sales and marketing professionals, technology consultant, management consultant, human resource management consultant, and legal. Now these fees need to be negotiated very, very aggressively with each one of these. Deducting any shortfall in the quality of the deliverers or non-deliverers, normally which is this clause is not there. Bid or purchase price related, two opportunities. One is the negotiating the bid price, which can be based on any of the combination of arriving at the bid price, like comparable company analysis based on price to earning ratio, price to sales ratio, enterprise value, etc. Comparable transaction for the similar type of recently acquired companies, discounted cash flows for 5 years, assets based valuation 5 years, industry specific, and any other proposal by the consultants, and review of the representation and warranties, which are very important, which are offered by the M&A. One has to read in between the lines. Bid purchase terms 12. There are 12 opportunities. One is the negotiating the financial structure of the proposal, which may include stock purchase option or asset purchase option, or both, or any other alternative. Payment terms for M&A: down payment and progressive based on milestones. The need to retain part of the purchase price in escrow account towards unresolved liabilities of the target company. Financial break fees, that is the amount payable to the target company in case the M&A deal fails through due to financial issues. And exit clause, key manpower to be acquired from the target company, and cost, labor cost, and union agreement related costs. uh, Particularly important is the post-retirement cost payable. Restrictions, particularly those affecting post-merger operations of the acquiring company, employees emolument, transfer, retirement age, and pension matters, regulatory approvals, cost sharing, responsibility and timelines, change management costs, for smooth integration between the acquiring company and the target company, cost related to delays in merger and acquisition, and research negotiation timelines. Now, these are the uh, uh, total cost saving opportunities which exist, which need to be negotiated very aggressively. Statutory approval related costs, optimizing the charges or the cost related to the approvals from the SEBI or RBI or NCLT, and of course shareholders of the plans and tax authority vis-a-vis capital gain tax, transfer pricing, indirect taxes also. And then there are post merger integration costs which are also involved, which need to be reviewed and optimized. One is the cost towards additional working capital requirements post merger, training cost for the acquired employees, channel partners, cost of funding additional capital requirements, cost of meeting the key vendors, channel partners, etc., which may be located in different cities and states and countries, to explain to them about the M&A concept which has been implemented. Cost saving opportunities, investment rate. There are 21 opportunities identified, and these are broadly under the areas of six. One is direct equity investment rated. Number two, mutual fund rated. Number three, derivatives rated, index fund rated, ETFs, exchange trade fund rated, and others. One by one, I am explaining that. Now, direct equity is related. Three opportunities exist. Now, first of all, investors can, within the context of India, directly invest in the stock listed in Bombay Stock Exchange or National Stock Exchange through brokerage firms such as Zerodha, ICICI Direct, HDFC Securities, Sharekhan, just to name a few. Investors need to choose carefully brokerage firm and enable cost minimization of the following. Number one, transaction costs including brokerage fees and taxes, taxation including short-term capital gain or long-term capital gain, and the gains, if the gains exceed more than 1 lakh for stock more than 1 year, then limits and rates may be changed at the discretion of the government. Consultant fees. This needs to be factored for engaging investment consultant for the evaluation of the high value investments in stocks of various companies, including equity stocks in overseas funds. Mutual funds. There are 5 opportunities existing, and investor need to choose these MF that maximize returns, and choose brokerage firms that minimize the cost. Of course, the funds, the MF can be of different types. These are mutual funds, equity funds, debt funds, and hybrid funds. Now, the costs related are: number one, investment fees, exit loads, account maintenance fees, consolidated accounts, and the taxation, which is similar to the one which was captured in the previous slide. And investor can choose instruments that offer tax advantage funds. Uh, Number two, number C is number three is derivatives. Now, an equity derivative is basically a financial instrument whose value is based on the equity movement of the underlying assets and offer high returns but high risk as well. Now, derivatives trading, including futures and options, occur on the BSE, Bombay Stock Exchange, and National Stock Exchange. These exchanges offer a wide range of derivatives products and can use investor can use either choice one or choice two. Choice one is the put option, which is a bet that stock will fall vis-a-vis strike price, and choice two, call option, which is a bet that stock will rise vis-a-vis the strike price. Investors need to choose these derivative products very carefully that maximize return and minimize the cost. Now, costs are transaction costs and margin requirements, and number two, taxations, which is similar to the one earlier, but here the profit and losses from the derivative trading are treated as speculative income and taxed accordingly to tax rates. Index funds. Index funds in India typically track popular indices such as Nifty 50, NSE, and Sensex BSE, and other sectoral indices listed in the BSE and NSE. These are typically purchased through stock exchanges such as NSE or Bombay Stock Exchange, and below listed are few of the important popular index funds in India historically, known for their strong performance. One is ICICI Prudential Nifty Next 50 Index Fund, UTI Nifty Index Fund, SBI Nifty Index Fund, HDFC Index Fund, Mirai Assets Large Cap Fund, and so on and so forth. Investors need to choose these index funds very carefully, and which enable maximizing return and minimizing cost. And cost, again, here are of two types: charge and expenses related to the cover management fees and operational cost, and taxation related as explained earlier. uh, ETF, exchange rated funds. Two savings opportunities exist. And what are ETF? ETFs are listed and traded on stock exchange like BSE and NSE. An investor can buy and sell ETF units during the trading hours. And ETFs often track benchmark indices like the Nifty 50 and Sensex and sector specific indices. Few examples of ETFs are Nippon India ETF Nifty 50, SBI ETF Nifty 50, UTI Nifty Next 50 Index, RDBI Gold ETF, which monitor the physical gold prices, and Kotak Banking ETF tracks Nifty Bank indexes. Investor need to again here choose ETF that maximize returns and minimize cost. Cost including charges, expenses, ratios to cover the management fees and operational costs. Others. Now, beside this other, beside the above listed examples of investments, there can be investor can also make use of FDs and debt instruments or different durations and the real estate. In the case of debt instruments, investor can buy fixed deposits, term deposits, or recurring deposits. Here, the investor need to clearly choose the bank or the company in which they are will invest and the FD or debt instrument rate, and that maximizes return and minimizes cost. Costs can be of in this case usually no costs are there, but can be penalties or charges towards premature closure or reducing the principal amount. Others. Continuing real estate. Real estate investment can be of either land buying, residential building buying, commercial building, hospitality, education, and so on and so forth. Investor need to choose the type of the estate investment plan to meet their purpose, and that would maximize returns and minimize cost. The cost reduction opportunities are brokerage costs, negotiating brokerage costs, surveyor fees, advert and lawyers fees, statutory license or registration fees, land use charges fees, and development charges. JV related. There are 14 opportunities identified for the JV. These are and these need to be negotiated very carefully. One is the lump sum know-how fee for the import of designs, drawings, etc. And technical know-how, pricing of the import or in-house produced or bought out BOM from JV as CKD, SKD, etc. JV formation expenses and cost sharing, initial capital contribution by each partner, free training overseas and in India and overseas, training costs beyond free days, mandates, rate and fee for those eligible, and expatriate emoluments. All these elements, cost elements, they need to be negotiated very aggressively. Continuing, payment remittance methods for each type of the remittance, payment terms for different remittances like securities, SKDs, spares, etc., or equipment, currency, USD or any other, expense sharing formula for ongoing cost of JV, pricing for future exports of the materials from India to the JV partner, and fees for export of services or manpower from India, and tax sharing formula for negotiating a tax sharing agreement that allocates the taxes. Royalty rated. 7 points are there for cost saving. One is the computation of the formula for the royalty, how the royalty will be computed, percentage and definition of the net sales on which it is payable or any other method, percentage royalty rate, duration for which period for which how much period royalty is payable, maximum royalty amount cap if any, currency, royalty structure to comply with the Indian taxation and its optimization, and payment terms based on the milestones like product launch or sales target accomplishment. Most of these which I am saying is based on my experience in managing and handling these else somewhere in the career. Way forward, implementing cost reduction. Promote a conscious culture by making cost reduction as essential KRAs across the organizations. Deep dive into the process activities for each sub-function. Embracing cost and spend analysis. Uh, Periodically benchmarking cost in the industry. Challenging every cost or expense, explore outsourcing options, renegotiate fees and charges with service provider, consultant vendors, installing system for monitoring the MTD, month to date and year to date budget versus actual performance, and automating manual processes. These are all and these will all enable cost reduction. Future references. You can refer to my second book, Profitability and Ethics, Essential Ingredients for Business Success. And the book is listed on the Amazon as per the links given below. And all these chapters, there are chapters related devoted to the 6 areas which I have talked about in this slide. And you can also refer to some of the blogs on the website related to the corporate finance and accounts function. And you can also see some blogs on my website and Facebook and LinkedIn. Thank you very much.